we're going to hear Tom Lee speak about, this happened actually from today, the other one's from yesterday. Inflation is going to fall like a rock. Looking forward to hearing Tom Lee's opinions and perspectives on that.
500 number, but it doesn't necessarily reflect how you think the year is going to end. Are you going to take a look at your year-end targets now?
We are, Carl. At the early December last year, we thought S&P could reach 5,200 this year, which at the time was almost a 20% gain. We've obviously moved well above it, and the fundamental picture to me looks stronger. I think earnings next year, we originally thought would be 260 for 2025. It's probably closer to 275. I think the war on inflation has been meaningfully better in terms of progress. I know there was a lot of dispute, but I think the last two inflation reports and the fact that 55% of inflation components are back to pre-pandemic levels means inflation is really going to fall like a rock. These are factors that give us comfort that multiples can expand. And so I think 5,200 is clearly too low, but I don't know how much above 5,500 there is into year end. So I think in a couple of weeks, we'll be addressing that.
You actually use a graphic of a falling rock in your charts to describe elements of inflation that you think are dropping. You said we're beginning to see insurances break, waiting for shelter to follow suit. Some of your forecast, Tom, on new cars and used cars, do you actually think we could see that kind of deflation?
Yes. I think one thing to keep in mind is that there's almost 290 million cars on the road today. So when used car prices fall 10% and they're continuing to fall, that's a meaningful amount of disinflation and may be painful for people who borrowed money to buy cars.
That's a good point.
But that is also saving people who are buying cars. And so I think there's a lot of goods disinflation in the pipeline, and especially with new cars, inventories have really been picking up. The CDK cyber security hack might sort of disrupt it short term because there's a shortage now of new cars available, but I think the trend for new cars is also lower.
So the trend for new cars lower and used cars lower, that is what? What? That is recessionary. That's what that is, right? Is that good? So can you expect, a great ripping economy if you have car prices going down? No, you can't, right? If used cars are being devalued, let's say he says 10% there, and new cars, they have to drop prices, right? Well, imagine all the people that have loans on those autos that are already paying very high interest rates and then are underwater on their vehicles, right? That, at the end of the day, is kind of a recessionary thing in itself. And so, therefore, you have to expect some weakness in earnings from companies, right? And then you can also expect auto loan delinquencies to go up, which they're already at pretty much the highest they've been in over 10 years. And you'll expect credit card likely delinquencies, which are already the highest they've been in at least 10 plus years, right? And so you look at it from kind of those factors, then what happens then is banking system, right? They start to contract. They start to not give as many loans out there. Simultaneously, if you go delinquent on a car payment, if you go delinquent on credit cards, whatever, right? Your credit score does what? Your credit score then drops, which then in turn means essentially you are going to not be able to get all those loans and all those credit card offers and in the future, right? And to go buy a new auto on a big loan, right? You're going to have to wait likely years to kind of build back up your credit, which then that is a recessionary for the economy because then people can't spend as much, right? So these are all things to kind of factor in here. And that's a problem with Tom Lee that I have. That's pretty much the only problem I have is he just doesn't look enough at the other side of the coin. And he just is a little too rosy glasses all the time, which is a great perspective to have when you're in a bull market, but it makes you look really, really bad when you're in a bear market because clearly, people can see that he just doesn't look at it from the other angle, right?
Tom, what happens to earnings estimates in this environment? I mean, I get that it's good for the market if inflation falls and the Fed starts cutting rates, maybe that trumps everything, but if the economy starts to really weaken and these forecasts for Q2 are coming down, then what about the earnings picture?
Well, it's, first of all, there's always winners and losers. There's a lot of companies in sectors that have no correlation to inflation. Technology is one example. And there's many groups highly correlated to the rate of inflation, like basic materials and energy. We're not talking about overall inflation going negative. It's actually that it's going towards 2%. So there's still plenty of companies that are getting price. And as you know, the biggest pressure on many companies' margins has been wage pressures. That's cooling a lot, and gasoline's cooling, and that's really helping consumer wallets. So I think it's pretty complex, but to us, if the global economy is picking up and earnings delivered have already is suggested 270 for 2025, I still think we're maybe going to be closer to 280 next year.
I don't know, real wages are going down, though, so do keep that in mind.
Tom, if markets tend to lead the fundamentals and we've run up here, to let's say 21 times forward earnings, why would improved earnings relative to expectations now lead to multiple expansion, on top of what we've already had?
It's a fair question. It's really the composition of what contributes to the gains, because if you look at S&P forward, it is high. I think forward earnings multiple is like 19, but the median is 16. And the median PE in the Russell 2000 is actually 11 times. So I think that there are going to be many stocks that can re-rate towards 20, but the PEs many stocks that are at 27 PE, I mean, they could increase in their multiple, but I think there'll be a lot more juice in the 16 multiple going to 20 than there is 27 going to 28.
That's
hey, finally,
point.
Tom, 5 days in a row, S&P headline index and breadth have diverged. We haven't seen that kind of streak since the late 90s. Are we going to start assembling lists of analogs to the late 90s, and is that a good thing?
Carl, the late 90s didn't end well, so I think if this is going to look like the late 90s, then investors do have to be really preparing some portfolios that are appropriate for that, and that that in the 90s, late 90s, that meant to really be patient with value, and then of course be ready to exit the high momentum. In some ways, I think the skepticism that exists today is, I was an analyst starting in 93, so I saw the 90s. There was a lot more ebullience back then, and a lot more people who didn't think stocks could ever go down. I think there's a lot of top callers today. So for me, this feels a lot more mid-cycle. And I know it sounds surprising, but there's just too many top callers, especially among our institutional clients.
Yeah, it's not even really about top callers or not top callers or anything like that. What it's really about is, where do these companies' earnings go, right? Do we see, what point do these companies on a sequential basis, meaning essentially on a quarter-over-quarter basis, their growth start to become very minuscule, right? And specifically, what stock am I thinking of? I'm thinking of NVIDIA, obviously, right? And when that happens, then people are going to be worried about declines coming. When does that happen? That might not be till 2026. So maybe that's the moment, the real cracks start to show in the market, right? Outside of some epic recession or something like that beforehand. And so that's a moment everybody's really waiting on, is that specific moment. And then we can talk about, then the big downfall comes. But until you get that, it's just really hard to get the market down, because the companies are just reporting, specifically NVIDIA, such great numbers quarter after quarter on a sequential basis, right? So that's kind of my thoughts there. Hey, I hope you enjoyed that clip here today. Listen. If you're an investor in the market and you do not feel like you're at a high enough level yet, let's say you understand some things in the market, but there's a lot of stuff that maybe you're watching my videos, you're like, I don't really understand. What exactly is that? How does this work? How do I find if a stock's undervalued or overvalued? How do I understand these financial statements on a higher level? All those sorts of things that you need to understand. I want you to click on the first link in the description down there. That is an application to join my private group, which has access to all my best course curriculums to teach you everything you want to know about this game, and all these things you might not fully understand. It's going to teach you that, okay? Plus access to my Discord community of 6- and 7-figure investors and myself in exclusive videos as well. First link in the description down there. Apply, and once you join in there, say hello to me. After years of debate and thought about a recession, I'm here to tell you today it is officially here. The recession is here. It's everywhere you turn at this point in time. And no longer can we say it's just there's weakness out there, or some businesses, the growth rates aren't quite there. No, we're getting too many large companies to come out and tell us that their revenues are literally going negative now at this point in time. So we're going to cover that. We're also going to talk in this video, how does this happen, right? Public count, I believe today just hit a new all-time high, right? $2.21 million, up $28,000 here today. So how is that happening when we're now in recession, in my personal opinion, right? So right off the bat here, this came out here today, Walgreens to close up to a quarter roughly of its 8,600 stores. This is pretty shocking because this is going to mean, if they're going to do this is going to be over 2,000 store closures, which is a pretty shocking number. It's going to negatively affect tens of thousands of jobs. It's not like this is a small amount. This is like a substantial, right? Walgreens Boots Alliance will close a significant portion of its roughly 8,600 U.S. stores as a pharmacy chain seeks to turn around its struggling business, which has been hit with inflation-weary customers paring their spending. The current pharmacy model is not sustainable, says the newer CEO there, Tim Wentworth. With 75% of the company's U.S. stores accounting for 100% of its adjusted operating income, the company plans to examine the remaining 25% of stores for closures, right? I mean, this is scary. And the reason this is scary, it's not just about, wow, there's going to be a lot of jobs disrupted in this, right? But the other thing that's scary is for a company like Walgreens, one of the big competitive moats Walgreens had over the years. If you don't understand this company, I used to be an investor in this company. I used to work for this company. And I understand, like, one of the big competitive moats for Walgreens was, guess what? Having a huge store network. And the reason that was so important is you could go to any city, any area, and there'd be Walgreens all over the place. And so it made it very easy if you were traveling, if you were moving somewhere, to get your whatever you needed from the pharmacy, essentially, right? And the drive-through, that was another huge competitive moat around that. Well, if you're going to close 2,000 plus of your stores, you just made it more, your customers' lives more inconvenient, which then starts getting to a bigger cut. Next thing you know, your stores start underperforming even more, and then you got to cut another 1,000 stores, another 1,000. Next thing you know, do you even have a store model anymore at that point in time? Now, the other thing is, this could affect 50,000 plus direct jobs, right? But the question is, how many indirect jobs? And as somebody that used to work for Walgreens, there's a lot of people that make money from Walgreens that aren't Walgreens direct employees, and they make money from the company. The folks that do signage for Walgreens, right? The lighting, exterior cleaning, like we weren't out there cleaning the parking lots like the Walgreens employees. You used to hire a company to go ahead and do that, right? Painting of the stores, exterior, interior, and all the maintenance that has to happen with the stores, right? Registers, equipment, phones, computers, all those sorts of things. And that's all going to be disrupted now at this point in time. And the other thing that's going to be disrupted, and this is more of a long-term thing that's going to be disrupted, is actually pharmacists. So pharmacists has been I think a great industry over time for people to get into if you want to make six figures a year. Like the median annual wage for a pharmacist is $134,000. That's always been an industry that it's like, get into that. You've got a guaranteed job. You're going to make six figures a year. It's going to be gravy, right? But I think this is actually going to be disrupted. And the reason being is I think what happened today signals, I don't want to say it's the end of pharmacists because we're always going to need pharmacists, but in terms of the incredible demand for this industry over the past 20, 30 years, that's going to slowly start to come down. And the reason being is a lot of what's going on here with Walgreens is going to shift to other companies, and these online companies are not going to hire even remotely close to as many pharmacists as somebody like a Walgreens used to. That's one of the big advantages for them, is they're going to cut down on costs substantially. They're going to use programs, they're going to use machines, and they're going to get around the system to not use nearly as many pharmacists overall, right? And Amazon's really going to be a direct beneficiary of this. Amazon stock, we're now up $95,000 in this position. We're going to be up a lot more in the future. And Amazon's going to be, it's pretty clear to me they're going to become long-term the pharmacy giant of the United States of America, right? And so that's just all a process that's going to play out over many, many decades. And, today became very, very clear. And the thing that's scary about Walgreens is their pharmacy business is actually pretty good and relatively stable. The reason they're going to have to close thousands of stores is because the rest of their business is doing so bad, right? Which is kind of scary. Now, there's a company named Pool Corporation that, unless you're in the pool business, I would say probably 95% of you guys never heard of this company before. But it's a very important company if you want to know what's going on with the economy. Pool Corporation, the world's leading distributor of swimming pool supplies, equipment, and other related outdoor products. So this company just tore down all their guidance, all their numbers, what they're expecting for this year. It's bad. But here's the deal, okay? The bigger challenge is on new build and remodeling work, where Pool has been forced to cut guidance. It expects new units to be down 15 to 20% and remodeling be down 15% versus a prior guide of flat to down 10%. Now in Q1, management saw permits down 15 to 20%, but believed they would be an improvement, which simply did not materialize. So this Pool company essentially, how do I put it simply? Like, people aren't going to be building nearly as many pools or remodeling pools, okay? The numbers are not going down a little bit. I mean, we're talking about 15, 20% down on a year-over-year basis, right? And we're talking the business is trending much worse than management expected, which then makes you think this company is not even close to a bottom in terms of this. It's actually going to probably get worse for them over the next several quarters. When management is so far off like that with their guidance, it likely means the business is going to deteriorate quite substantially more for at least the next 2 quarters, if not up to the next 4 quarters for this company overall, which is bad. Now, if you know me, you know I grew up in the pool business, right? My dad had a pool cleaning business, and then he also would do repairs and also do remodeling. And I would go to work with my dad all summer long, every single summer, right? And so I learned in that business that, you know, if we looked at that business prior to 2008, when people went, like my dad had a lot of customers coming to him prior to 2008 that would want to get their pools remodeled. And it was a pretty, like my dad never sold them on it or anything. They came to him and said, hey, I want to remodel my pool. Then my dad would kind of be the guy to make sure everything goes right? And, you know, basically contract a likely pool corporation, and those workforces would then be the ones to go do the remodel. He was just kind of the guy overseeing it, right? And he would kind of get to make a fee off that. And they were coming to him left and right prior to 2008 because a lot of folks were looking at it and they're saying, yeah, if I spend whatever amount of money remodeling my pool, it's an investment. And that's the way people would look at it. It's not an expense. If I spend, you know, I don't know, $5,000, $10,000, whatever amount it is, right, on remodeling my pool, it's an investment, right? But then 2008 to 2011, I don't know if my dad had even one customer reach out to him to remodel their pool, right? And the good thing for him is he's got that stable, obviously, you know, recurring business, which is cleaning pools. But in terms, and, you know, problems happen with pools, filters break, motors break, things like that. But in terms of people wanting to remodel, no one's coming to him to remodel their pools during that particular time. And the reason being is now people started to look at it as an expense over an investment. And his customers wasn't like they lost their jobs because he works, you know, pretty much all for retirement folks, right? But here's why. If you look at what happened in Phoenix, Arizona with real estate pricing back from like 2000 into 06, 07, right? I mean, prices went up, they skyrocketed, right? And so this is why people did not mind remodeling their pools back during that time, because they're like, hey, if I spend $5,000, $10,000, $20,000 on this remodel, it's an investment. Look at how much my house is appreciated. It's nothing for me to spend money remodeling it, right? But then when real estate prices crashed massively, this is why no one was coming to him and saying, let's remodel my pool, because they're all looking at it and they're like, why would I put money into this thing where, you know, it just loses value, and it's lost, you know, 40, 50% of its value over the last few years, right? That's important to understand that. Now, you look at pending home sales, right? I mean, it's like lowest we've ever seen it. Lowest we've ever seen it. That's about as recessionary as you get. The home market's dead right now. If you're a realtor, if you're a mortgage broker, if you're anybody in the real estate industry, this is honestly as bad, or if not worse, than anything you've ever seen in your career right now, right? Let's be very clear about that. I honestly don't know how a lot of realtors and folks are making it right now. I really don't. Like, this to me looks worse than the Great Recession, far worse than the Great Recession. I don't know how those individuals are making it. It's brutal. I mean, absolutely brutal, right? That leads us to kind of what to do in this market, like where to invest your money, how to view a market like this, those sorts of things, right? Well, let me put it to you like this, right? Let's say we have person A and we have person B. Who would you rather invest in out of these two individuals? And I want to break it down like this because it's going to allow you to think about companies a little bit differently, right? If I told you person A, they have $200,000 in assets, they have $5,000 in liabilities, they have $100,000 income last year, and then projected income this year is $115,000 for person A. Then we have person B, $5,000 in assets, $200,000 in liabilities, $50,000 income last year, and then they have a projected income this year of $45,000. Which of these two individuals would you invest in? Anybody? I hope that every single person watching this video right now, each and every one of you, 30,000, 40,000 people watching this video right now, I hope you said this person. Please, please. Oh gosh, if you said person B, I don't think you should do this. I don't think you should invest. I think you should hide in a hole somewhere, okay? Everybody should have said person A, but that's easy, okay? What if I said you have to pay 3x the price to invest in person A versus person B? And I said, if you invest in person B, you get a big discount for investing in them. I still hope you said, okay, even if I got to pay 3x the price, I'll gladly invest in person A. They had their stuff together. This person B's a mess, okay? I hope we'd all say that. And so the way I just ran you through that is also the way you got to think about your investments in terms of investing in companies, right? Because there's going to be a lot of companies that are going to give you big discounts. There's a lot of them in this market right now. And when you're in a recession, that's what happens, right? And that's why you see so many stocks down 30, 40, 50, 60% right now, right? And they're giving big discounts. But at the end of the day, sometimes you got to pay up for the actual top tier quality because, it's just a lot easier to invest in that high quality versus the kind of mess and hope and pray it turns around and becomes person A, right? Now, we also look at consumer sentiment. It's horrible, but it's not like it's new horrible. It's been horrible for really 2 years now at this point in time. Michigan consumer sentiment, they've been doing that for such a long time. These numbers have been horrible for 2 years. Honestly, they've been bad even back in the Rona days, so they've really been bad for 4 years. Now at this point in time, 4+ years, but they've really been ugly the past 2 years. Like we hit all-time lows pretty much, right? And so what this shows me is when you invest in companies, you've got to invest into strong brands, especially if they're doing business with the consumer. And you've got to invest into companies where their customers have a lot of money. So let me put it to you like this, like a Palantir, right? Well, Palantir does business with big companies. Well, their clients have a lot of money. Great to invest into, right? If I think about NVIDIA's been a great company to invest in because even though consumer sentiment's been horrible, guess who NVIDIA's biggest customers are? They're Amazon and Meta and Microsoft and all the biggest companies in the world. Their clients have money. There's no shortage of money for those companies, right? So same way I'd also think about it for companies that are doing business with consumers, right? You look at Honest stock's up 68% in the past year, right? I think it's probably going up a lot more over the next year. And I look at an Honest, and why? Well, their financials have improved dramatically. Their revenues are going up very nicely. And Honest's customer base has not been hit by inflation as bad because Honest caters much more to the upper middle class than, let's call it, the true middle class or under the true middle class, like a lot of other brands might, sell to. So Honest has been doing very well, even though its consumer environment has been horrible, right? Wynn Resorts, although the stock price hasn't done a thing, so far this year, their customer base seems fine. Wynn caters to the top 10% of income earners, the top 10% of the wealthy, right? And so they've been benefiting in the United States with their properties. They've been benefiting in Asia. The Macau properties are doing phenomenal, and Wynn's going to continue to do phenomenal, really regardless of kind of what's going on here, and regardless of these consumer sentiment numbers, and regardless of credit card delinquencies being, up where they are, and auto loan delinquencies being the highest in 10 years. Wynn continues to put up phenomenal numbers. Elf on a Shelf up 101% in the past year. This company, it doesn't really matter that credit cards are here and this company's revenues are going down. This company's revenue, Elf puts up their numbers regardless in this situation, right? So what you need to do is you got to look for deals, right? Look for deals out there. Take advantage during this time period, and don't look back with regret in this situation because a lot of people, when they go through recessions, when they go through, a lot of stocks being down, which let's be very clear, there's a massive amount of stocks down huge right now. The markets are at all-time highs, but let's be clear, that's just because of, the very top of the market is doing phenomenal. But in this sort of market, take advantage of this time period. Look for deals. There's deals everywhere out there, right? And continue to take advantage of those deals because there's plenty of them out there. There's going to be more, and you want to make sure you know what you're doing and take advantage of the quality, though. That's the big thing.